When people hear PepsiCo, they think of Pepsi. But for an investor, that is a dangerously simple view. PepsiCo sells beverages, yes, but it also sells Lay's, Doritos, Cheetos, Quaker, and many other brands across more than 200 countries. And in 2025, 58% of its revenue came from convenient foods and 42% from beverages. To understand Pep, you need to look at two economic engines that share brands, distribution, customers, and scale. And when we cross-reference the business report with management's explanation of the results, risks, and financial statements, 5 clues emerge that I would follow before even thinking about buying the stock.
So let's start with something that, to me, is key. PepsiCo is growing more through price than through volume. In 2025, revenue grew 2% to $93.925 billion. At first glance, that looks like growth. But when we separate price from volume, a different picture appears. Organic volume fell 2%, while effective net pricing contributed approximately 4 percentage points of growth. In North America, this becomes even clearer. In beverages, PepsiCo Beverages North America saw organic volume decline 3.5%, offset by approximately 5 percentage points of pricing. In foods, PepsiCo Foods North America also recorded a 2% decline in organic volume.
This matters because a company can increase revenue by raising prices for a while, but the economic story is stronger when it is also selling more units. The company itself acknowledges that pressure on consumers can push them toward lower-priced products or private label brands. So my first quarterly variable would be very simple: organic volume versus effective net pricing. If volume starts recovering without sacrificing too much on price, that would be a positive signal. If volume keeps falling and growth becomes increasingly dependent on higher prices, the signal changes.
And this brings us to the second point worth watching. A large part of the problem is precisely in North America. Management itself says that one of its priorities is to reinvigorate the North American business, and the numbers explain why. PFNA, PepsiCo's food business in the United States and Canada, ended 2025 with a 2% decline in volume and a 7% decline in reported operating profit. PBNA, PepsiCo's North American beverage business, saw unit volume decline 3%. Its reported operating profit fell 53%, although much of that came from the Rockstar impairment and other charges.
So the clue is not to look only at consolidated profit. I would monitor PFNA and PBNA separately every quarter: volume, organic growth, and adjusted operating profit. If both recover volume and profitability at the same time, PepsiCo's improvement starts to rest on a much stronger foundation.
But recovering sales does not depend only on what PepsiCo sells. It also depends on how effectively it gets those products in front of consumers. And that brings us to another important part of its competitive advantage: distribution. PepsiCo uses direct store delivery, customer warehouses, and third-party distributors. Its direct distribution system allows the company to place products, restock them quickly, and maintain greater control over their visibility. That network, combined with well-known brands, appears to be an important part of its moat.
But here, we find a contradiction. Walmart and its affiliates represented approximately 14% of PepsiCo's revenue in 2025. At the same time, the company acknowledges the growth of hard discount retailers, e-commerce, and private label brands, as well as customers that, in some cases, are moving away from direct store delivery. What would I watch? Quarterly references to promotions, pricing pressure, shelf space, and changes in distribution channels, together with volume and gross margin. If PepsiCo needs to offer more promotions to defend volume, we could see sales stabilize while margins deteriorate. That would be a sign that defending the moat is becoming more expensive.
But recovering sales does not depend only on what PepsiCo sells. It also depends on how effectively it gets those products in front of consumers. And that brings us to another important part of its competitive advantage: distribution. PepsiCo generated $12.087 billion in operating cash flow in 2025, compared with $12.507 billion in 2024, a decline of 3%. However, free cash flow rose 9% to $8.2 billion. Why? To a large extent because capital spending fell from $5.318 billion to $4.415 billion. In other words, the increase in free cash flow did not come from an expansion in the cash generated by operations. That is why I would follow four figures: operating cash flow, capital spending, free cash flow, and debt.
Long-term debt increased from $37.224 billion to $42.321 billion, while net interest expense also rose. In addition, PepsiCo spent $3.391 billion on acquisitions, paid $7.638 billion in dividends, and repurchased $1 billion of stock. If operating cash flow starts growing again while debt stabilizes, the company's financial quality improves. If cash flow weakens while debt, dividends, and acquisitions continue to rise, I would pay attention. Because if PepsiCo is spending billions of dollars buying new brands, sooner or later those acquisitions have to prove that they can actually grow the business. In 2025, PepsiCo paid approximately $1.95 billion for Poppi and $1.2 billion for Siete. These acquisitions fit with its attempt to adapt the portfolio to changing consumer preferences. But the 10-K contains a warning. PepsiCo recognized around $1.9 billion in intangible asset impairment charges, primarily related to Rockstar. A brand can look strategic today and end up being worth much less than expected tomorrow. That is why I would follow the contribution from acquisitions versus organic growth. If reported revenue grows because of new acquisitions, while organic volume continues to decline, the company may simply be buying growth. But if Poppi, Siete, and other brands begin driving volume, margins, and cash flow without continuously increasing debt, then they are strengthening PepsiCo's economic engine.
So PepsiCo is not simply a story about whether it sells more Pepsi or more Doritos. The real question is whether it can recover volume without giving up pricing, fix North America, defend its distribution network without sacrificing margins, convert profits into cash, and prove that its new brands can generate real growth. Those are the 5 clues I would follow quarter after quarter. If several of them start moving in the same direction before the market narrative changes, that is where an opportunity could begin to appear.